and welcome to Lesson 4D, Loan Payments, Credit Cards, and Mortgages. I just want to say that with these crazy events that are going on, I hope everybody's safe and healthy. And I hope that we can all get through this experience together. Just know that I'm trying my best to do this content all online. So if you have questions, don't be afraid to email me, please. So Lesson 4D is all about loan payments, credit cards, and mortgages. It's common, these are just common ways that you owe money, okay? Car loans, you'll experience, if you haven't experienced it yet, you'll experience it sometime in your life where you buy a car, borrow money from a bank. Credit cards, that is considered borrowing money. You're saying, here, pay for it now, and I will pay you later. Student loans, great way to get through school. If that's what you have to do, it's a great opportunity to make sure your school is paid for. And mortgages, if you have more questions about mortgages, you could ask your parents. They would know a lot about it. But at some point in your lifetime, you will buy a house and you will have a mortgage on it. You have to pay back the money you borrow plus interest. So that's what we're going to talk about today. So the first problem we run into is about interest. It says, let's suppose you borrow $1,200 at an annual interest rate of 12% or 1% a month. At the end of the first month, how much do you owe in interest? Well, how you solve that is you do 1,200 times 0.01 and you get 12. So you owe $12 in interest by borrowing $1,200 for the month. If you only pay $12 in interest, you still owe $1,200. And then the next month that rolls over, that $1,200 is multiplied by the interest rate again, and you would owe $12 more. So if you only paid the interest, you owe $1,200 forever. This is why it's not key to pay off any credit card debt or things like that the month that you spend it, so you don't have to pay extra in interest. Let's look at some vocab. So principal, the total loan amount. You need to make payments on the principal or you'll never get out of debt. So as you pay it off, the principal amount decreases. Loan term, the time you have to pay back the loan in full. An installment loan or an authorized loan, a loan you pay off with equal regular payments. Interest due each month gradually decreases. The amount paid toward principal each month gradually increases. So this is kind of one of those ways that a mortgage works. It starts off really heavy on interest with your principal being deducted slowly, and then by the time you pay off your house, your principal amount of your loan is most of your payment. So here's the equation we will use for the homework and these notes. It's the installment loan formula. So we have our starting loan principal with P. Our AR is our annual percentage rate as a decimal, and the number of payment periods per year, T, loan term in years. So the first question, it says, suppose you have a student loan totaling $7,500 when you graduate from college. The interest rate is 9% and the loan term is 10 years. What are your monthly payments? So first off, our P is $7,500. So we're going to plug that in right there. We're going to multiply this by the rate in decimal form. So 9% turns to 0.09. Remember, if you can't remember how to do that, take 9 divided by 100. That gives you that 0.09. N is total of payments in a year. And in this case, you're going to be paying on it monthly, so 12. And then on the bottom, we have 1 minus parenthesis 1 plus your rate over your number of payments again, so 0.09 divided by 12. And that is all raised to the negative n, so negative 12, times the amount of the loan, or the years of the loan, which is 10. Now, hopefully you have a calculator that works, and you can do this. Okay, in your calculator, you would type this in. and get $95.01. Okay, I should round to the nearest hundredth because we're talking about money. But you get $95.01. What I like to do is I like to break up the calculation instead of typing it all in once. I like to break up the calculation of doing the numerator, then the denominator, and since I have a graphing calculator, I go up and I select the numerator, divide it from the denominator, and it all works out for me. If you need help with your calculator, please email me. I can send out a short little video about how to plug it in. So yeah, please email me if you have questions. So continuing on, we already know the answer to this first part. We figured it out on the last slide. We're going to pay $95.01 a month to pay off our student loans. It said the second question says, how much will you pay over the lifetime of the loan? Well, for the lifetime of the loan, you're going to take $95.01. That's how much we're paying monthly. We're going to do that 12 times a year, and then we're going to multiply that by 10 years. This will tell us how much we pay for over the amount of the whole loan, which typing it into my calculator straight away, I get $11,401.20. So in 10 years, you'll pay $11,000. Now the next question says, what is the total interest that you will pay? How we figure that out is we take the total amount that we're going to pay, so 11,401.20, minus the total loan amount of 7,500. And by doing that, we get 3,901.20. So in 10 years, you will pay almost $4,000 in interest. That's how banks and these places that give you money in a loan, that's how they make their money, is by this interest rate. So if you can, for student loans, if you can pay them off quicker, then you pay less interest. And most loans nowadays have that option. If you pay it off early, there's no penalties, but you should always double check before you actually do that so you don't get hit with hidden fees and hidden penalties for that. Now let's continue. So buying a home. The most common type of installment loans are mortgages and car loans. Okay, lower interest rates than many other loans. Your house / your car is the guarantee. If you don't make the payments, the bank will take it. You can always look up these random shows on YouTube or TV that talk about repossessions. That's what they're talking about. Okay, repossessions would be for cars or trucks. Foreclosure is what they call for homes when you don't make your payments. Down payment, many home loans require 10 to 20%. If you can do 20%, then you don't pay something called PMI, which is private mortgage insurance, which is just an extra fee on top of your already house payment. Okay, so if you can do 20%, that is the best. Closing costs. Many lenders require you to pay fees, appraisal, credit checks, organization fees. There's so many fees out there when you get loans and mortgages that it's kind of scary. So just be careful, make sure you know what you're signing, check into those kind of things. Usually mortgages are broken up into two. You have either 15-year or 30-year loans. 15 means higher payment, but you pay off your house faster. 30, lower payment, you actually pay more interest, more money in interest in the 30-year than you would a 15 because you're paying it off slower. And then there's all types of loans out there, FHA, conventional, and they all have different types, different rules. Something you can look into. So you want to buy a home for 210,000, which would be a killer deal for a home right now. So if you find one like that that's decent, you should jump on it. You select a 30-year loan at 5%. What is your monthly payment? So we're going to do 210 as our initial loan times our rate, 0.05. We're going to do 12 payments a year, so that's why we're going to divide that by 12. And then we have 1 minus parenthesis 1 plus the rate over the amount of payments in a year. So 0.05 divided by 12. And then we're going to raise that to the negative 12 times. And then we said we selected a 30-year loan. Now, once again, I like to focus on the numerator and then the denominator and take those and divide them from each other. If we type this into our calculator, this is what I got, is I got 1,127.33. It's not bad. 210,000, 5%. You'll pay a little over $1,100 a month. Now that doesn't include property taxes and utilities and things like that, so you'll end up paying more for a home, just in random. Just give you a heads up, interest rates right now with kind of what's going on and what's been going on in the past year or so is interest rates are below 4%. So 5's a little high, but it's just a great number to type in the calculator. Now, how much will you pay altogether for your house? So if we take that monthly payment of 1127.33, we multiply it by 12, that's how many payments in a year, and then multiply it by 30, we will get the amount of money that you pay for your home in the 30 years that you have it. So what I got in the calculator when I typed it in was 405,837. So in 30 years, you will pay 405,837. Now the scary thing about that is your house was only 210,000. So you can easily do the math to figure out how much interest you paid in 30 years. This is why some people favor a 15-year interest rate or a 15-year loan, because you pay off the house faster. You don't pay as much in interest. Yes, your payment's a little bit higher, but it's, you get it paid off faster and you don't spend as much money. Let's look at the next example. So, let's actually change this up. Let's do the same $210,000. We're going to do a 15-year loan, but instead of 4.5, let's do 5, just so you can see the difference of 15 to 30. So we're going to do the exact same equation, 210. We're going to do 0.05 divided by 12 again, but in this time, the only thing we're changing is our interest rate, or not our interest rate, our 30-year to 15-year, just so you can see the difference of what's going on. So negative 12, and instead of 30, we're going to times it by 15. Let's do that, and let's see what we get. Typing it into my calculator as I speak. I get 1,660.67. So compared to our last slide where we had $1,100 payment, now our payment's up to $1,600. So we're spending about $500, a little more than $500 more a month, but we will pay it off faster because you'll see how much you'll pay for the total house. So we're going to take our monthly payment of 1,660.67. We're going to multiply that by 12, but instead of 30 this time, we're going to do it by 15. I'm going to type that into my calculator. And it says in the calculator that we will only spend $298,921. So for a 15-year loan, you were spending about, looks like 88,000 more than your house's was worth, and not that your house was worth that, but $88,000 more than you originally thought you were going to buy the house for. And when we did the 30-year loan, it was 405,000. That's almost $200,000 more. So $200,000 compared to 80,000, 90,000. You take your pick how much money you want. So we compared 30-year to 15-year. We already did that. Suppose your closing costs are the same. Which would you choose? What other factors do you need to consider? I would definitely choose a 15-year. Okay, you could say less money overall. Now the big thing you'd have to consider is, can you afford that $1,600 payment? And then also, how long are you do you feel like you want to be in the house? Is it your forever staying home? You'll raise all your kids if you have kids, or is it I'm only going to be here for 2 or 3 years and then I'm gone? If you're only going to be there for 2 or 3 years, you might want to just do the less payment, save your money, and then sell. So all depends. Now, if you plan on renting it right after you move out in 2 or 3 years, then you might want to do the 30-year loan, and then just pay off your mortgage faster. So it's easier to rent something out for, $1,300, $1,400, especially right now, than it is $1,600, $1,700. So just different things to keep track of. Now, credit cards. They're not installment loans. You're not required to pay off the balance off in any specific time frame. Rather, you must be a minimum monthly payment, which typically covers very, very little principal. Okay. So basically, going back to that first slide that we talked about, if you had a credit card loan of $1,200 at 1% interest a month, you owe $12. If you just have to make the minimum payment, which is usually the interest payment. As a result, it can take a very long time to pay off a credit card. Credit cards have very high interest compared to other types of loans. The ones I have on credit cards right now are 21 or 22%, so they're very high. So it is very key that you should pay them off as fast as you can, and hopefully monthly, before you are charged that interest rate. Let's try a couple problems. Suppose you have a credit card balance of $2,300 with an annual interest rate of 21%. You decide to pay the balance off over 1 year. How much will you need to pay each month? Assume you take no further credit card purchases. So our initial loan is $2,300. Remember, we're solving for our payment. So 2,300 times our interest rate. So 21% divided by 100 is 0.21. We're going to make 12 monthly payments. And we do 1 plus the same thing we did on top. 0.21 divided by 12. Now in this case, we're going to do negative 12 raised to the power of negative 12, right? But we're going to pay it off in a year. So we're going to type that into our calculator. Once again, if you need help with your calculator, please don't be afraid to email me and ask. I can make a short little video on how I would type this in to my calculator. First go round, I screwed up, so fixing it. Oh, what is going on? Oh. Let's try this again. I'm having some calculator malfunction. I guess I'm having too many parentheses or something like that. There we go. So monthly payment of $214. And don't forget to round to the nearest hundredth and 16 cents. So that's how much you'll pay each month as long as you don't make any more credit card purchases. Now, if you made more credit card purchases, that 214 is probably going to go up. So assume you make no further credit card purchases. So $214. That would take you that long. Now we could do the same question of how much you're going to pay over the amount of the year just by taking 214.16 and timesing it by 12. No point in timesing that by 1. So 214.16 times 12 is 25. 69.29. Oh, 92, sorry. So $2,569.92 is how much you would spend trying to pay off your credit card of $2,300. Key of credit cards, pay them off as fast as you can, hopefully every month. Okay. So the question is being asked. It says partner work. I'm just going to explain it. Susanna hasn't earned enough money to pay off all of her needed books and tuition coming the next month. She needs an extra $1,600. She's got a couple options. Option one, she charges the $1,600 on a credit card that allows her to make no payments for 3 years, but still charges interest during that time. Not usually an option. When she graduates from college, she now has $2,700 in credit card debt with an APR of 17.6. She'd like to pay it off in 5 years, assume she hasn't and wouldn't use the card for anything else. So let's figure out Susan's monthly payment off that 2,700 now. So we have 2,700 times our 17.6%, so 0.176 divided by 12. We take that and we do 1 minus 1 plus what we just did, 0.17 divided by, oh, forgot the 6. Divided by 12, raised to the negative 12 times 5. That right there, typed into the calculator. Hopefully while you're inside your home doing this whole social distancing thing, that you are staying sane and that you are also trying to find things that you enjoy to do. Almost have it all typed in. Here we go. So she's going to pay $67.98 a month for 5 years. Now, how much will she pay in total? Well, we take that 67.98 and multiply it by 12 and multiply it by 5, and we get 67.98 times 12 times 5. $4,078.80. So in the 5 years, she's spending almost $2,000 more than she should, or around $1,300 more than she should, just to pay off the credit card loan, credit card debt. Or she has another option. Option two, she takes out a student loan. The most federal student loans charge no interest until you graduate. The APR is 6%, and she'd like to pay it off in 5 years. So let's figure out Susan's payment for this. So we're going to go 1,600 times 0.06 divided by 12, all over 1 minus 1 plus 0.06 divided by 12. Negative 12 times 5 years also. Fix that. And get this typed into our calculator. Oh, it must be missing a parentheses somewhere. Let me double check my work on that. Ooh, I know where I went wrong. Let me hurry and fix that, everybody. Hey, I got me a smaller number. Ooh, I know what I did. I know what I did. I know what I did. Let's try that one more time. Alright, so we got some parenthesis problems here. See, everybody messes up with the calculator. It's okay. If you need help with yours, I will try and explain it to you. So what I got after I fixed all my parentheses was $30 and 0.93 cents. How much we should pay over the total of the loan? We take $30.93 and multiply that by 12, multiply that by 5, and we get $30.93 times 12 times 5. We get 1,855.80. Go figure. Which one would you choose? Hopefully you choose the less amount. And choose that student loan option. So what should Susanna choose? We said student loan. People usually choose credit cards. Just easy swipe, pay, worry about it later. Student loans you have to apply for, things like that. So most people usually use credit cards. So, not saying that credit cards are bad. It's just you gotta be careful with them. So homework is 4D. It will be on Math Excel. There will be a Canvas discussion with which formula, and your spending tracking should have been due already. And then jump on the which formula discussion board. In the next little bit, you will also have to go through the process to buy a home and calculate all these payments and things like that. That will also be posted on Canvas here shortly. So please pay attention to both Canvas, Math, Excel. Sorry, they're both two different places, but please go jump back and forth so you can keeping up with deadlines. Also, if you have any questions, please email me. I would love the opportunity to try to explain things if needed. But please don't be afraid to email me. Thank you. And